Oh, I can't get you.
All right. As we get started, I want to thank you all for coming and being here. We are recording this, so if you would like a copy of it, just let me know when we're finished. We are going to, as far as questions, let's take them at the end. The presentation is very short, and then there'll be a lot of opportunity to talk about maybe your specific deals or scenarios that you may want to talk about, or questions that you might have. So thanks for joining us, and I'm going to turn it over to Shane. You want to introduce yourself?
Hello, I'm Shane. I've been doing mortgages for 22 years now, and found that these products here are pretty helpful to a lot of people in the industry that are looking to, like Joey said, maybe start a new business or create some excess cash flow, or a lot of people are creating a retirement with it, I believe. So we'll share some information here, and like Kate said, we'll answer questions at the end. So think about any questions you can come up with, and we'll do our best to give you the information. So let me get this going. All right, so the topics we're going to go over, Kate, can you see the PowerPoint? Unmute yourself.
Yes, I can see the PowerPoint just fine.
All right, cool. Topics we're going over are fix and flip, DSCR, which is debt service coverage ratio, construction loans, and short-term rentals. So the fix and flip is for an individual or a business, depending on the state you're in. Sometimes you do have to have it in a business name. It is a pretty good idea to have at least an LLC set up so that you have some protection there if anything goes wrong when you sell the property, or even during the time of ownership. Interest on drawn balance option and 18-month loan term at no additional cost. So you can set your loan terms from 9 to 18 months, typically on these fix and flips. It's short-term financing. And a lot of the banks are giving what's called they reference it as a line of credit, but it's actually an exposure limit. You can't just draw the money out at your whim. Each project actually has to be approved as they come in. So, but you can have multiple projects going at one time, which is what the exposure limit is designed to facilitate. No prior experience is required. That is, oops, sorry. The no prior experience deal is limited to certain lenders. Not all lenders will finance you if you don't have any experience, but we do have options there. And as you have more experience, more better options become available to you, basically. All right, so the property loans are from $75,000 up to a maximum, which is determined on the specific scenario. So different banks have different maximums, and different credit score, experience level, things of that nature can impact the maximum amount the bank will finance you for. But if you're just getting started, that's not much of a concern. But for people that are doing a number of these, that maximum can, obviously come into play. 12 or 18-month terms. You want to set your term correctly so that you don't pay penalties if you take longer to sell the property, renovate and sell the property, fix and flip, than what the bank is planning for you to do, basically. So the short-term loan, the bank wants to turn their money in the time that they have established with the client. So it is important to try and stick to that. If you're going with 12 months, you want to make sure that you're going to have it done and off your plate in 12 months, and the bank paid off for that transaction. The minimum credit score for this is a 620. The better, the better terms come with higher credit score. And if you're at a 660 or above, the terms definitely are a bit better. And you have less money out of pocket on the better terms. Extensive rehab is financing is available. That references basically what you're going to be doing to the property. Extensive would be, physical remodeling and potentially putting, maybe an addition on. But definitely, like actual gutting the house, like ripping off drywall and taking out windows and things of that nature would be considered extensive, not just like cosmetic things. All right. There's an error we need to fix, Kate. The DSCR loans, purchase and hold and refinance. How to calculate DSCR. So you take the net operating income, which is your qualified rent. Qualifying rent is generated in a few different ways. Some of the banks actually have an estimator that we can use to figure out to estimate what that rent's going to be on the property. If your property is in an area where there's enough data available, sometimes we have access to that. If that's selected, then you don't have to use your lease or your appraisal to calculate the rent. Most of the time, most banks want to see either a lease with proof that you've been receiving a certain amount of rent, or they want to see an appraisal that has it's a rent comparison report, basically. So when you do comparable sales on an appraisal to generate a value, you can do something similar for rent, and you'll have comparable sales or comparable rentals there showing what the rental amount is for a property that would be similar to yours. So, and sometimes it's a blend of those three options. If you're going to provide a lease because your lease shows higher rent than the appraisal does, then you have to be within a certain percentage. Usually you can't go up by more than 15% above what the appraisal says the rent is. So there's different calculations that apply there, but in general, you have three ways of qualifying your rental income. And then that is how that's half of the equation there for the DSCR. So you take your debt service, which is your principal, your interest, your taxes, your insurance, and any homeowner association dues. You add those together, and that's divided by the income. So if your income is above a 1-to-1 ratio, the investors tend to be a little bit more flexible in terms, and will offer better loan to value, less money out of your pocket, things of that nature. We can do a DSCR that is lower than 1% or 1-to-1. The ratio would be lower than 1, so it'd say 0.75. We can still get those done, but the terms, rates typically will go up a little bit, and the amount of money you would need out of pocket, reserve requirements, things of that nature would increase. So the terms aren't as good when you go below 1. The terms are the best when you're at like 1.15 to 1.25. That's a pretty solid position for the investor or the bank, because they know that property cash flows, and you shouldn't have any trouble maintaining your payment with the lender. So the DSCR loans are only available on non-owner occupied properties. You can't do these on any property that you would live in or use as a second home. If you occupy, I had a person ask me a question the other day about, could they buy a beach house and rent it out most of the time, but still use it themselves occasionally? In that scenario, typically you would be okay, as long as the intent for that property is commercial use, and you're showing that you're renting it out to people. The reason this is an issue is there's very strict regulation of banks lending to people, and you can't do programs like, you're required to calculate debt to income ratio on a property that someone is going to live in. And that's one of the regulations. There's a number of other regulations that apply as well. So it's very important that these are only done on properties that you will not be living in. Some of the banks actually have a requirement that you have a primary residence already before they'll let you qualify for one of these types of mortgages. The loan size is $75,000 up to, it depends on the bank. Usually we're seeing a cap of around $3 to $5 million. Sometimes it's higher than that. It depends on the number of units as well. The minimums change when you get higher amounts of units. There's a lot of these types of loans are scenario specific, but we're just giving you some guides to go by here. First-time investors are allowed, but you can't be a first-time homeowner. They want to make sure, well, I take that back. We did just pull in a investor that will allow you to, you don't actually have to own a home currently to qualify, but you would have to show that you've been leasing a property for at least 12 months and paying rent on it. So the banks are going to, and the investors are going to make sure that you're actually going to, that you have a primary residence aside from the property you're purchasing. Max loan to value, purchase and limited cash out in general is set at 80%, but we can go above that. Depending on the investor and the terms and the experience level, we can go above that with certain investors. Cash out refinances are typically capped at 75%. A vacant property refi sometimes is capped at 65%. As we're bringing in more investors, we're seeing some leniency in some of these ratios, but this gives you an idea of how the programs end up being structured, and it's mainly revolving around a risk assessment for the investor in relation to the property that they lend on. So we have a lot of different terms available. In my opinion, the most attractive is a 30-year fixed rate as far as security goes, but if cash flow is your main objective on the property, we can do interest-only financing. The most aggressive I've seen on that is a 10-1 ARM, so that you're fixed for 10 years, interest only, and then after that, the interest rate would be adjustable. Seasoning requirements for 90 days for the appraised value use. So this is referencing cash out refinancing. The shortest seasoning requirement I have seen so far to use the appraised value to get your cash out is 90 days. You can get cash out prior to that, but you can't use the appraised value. You can only use the typically the purchase price. So whatever you paid for the house, if you paid cash, you can show what the purchase price was. We would verify that with your closing documents, and you can get your percentage of cash back on that. But if you want to use the appraisal, we need 90 days. Most of the banks are requiring 6 months, but we do have one at 90. 640 in general is your minimum credit score for most of these products. 620 on some, 640 on some. Once you get into the 660, as I said before, you're typically getting better terms. The banks are wanting these properties to be leased within 180 days of closing. So you need to make sure that if you're intending to rent the property out, or if you're going to renovate it, that you're giving yourself enough, you're structuring things so that you'll have the property leased within 180 days. I don't think the bank will come in and try to foreclose on you, but they do want to make sure that the property is going to be generating income so that you have the ability to pay the payment on the mortgage. Construction loans. We're doing construction on, these would be considered spec homes for contractors. And if you are not a contractor and you're having a contractor build a home for you, it's just an investment property, but a lot of these fall under what we call spec homes. Minimum requirements are 1 new construction property built, or fix and flip, or fix and hold in the last 36 months. So I have one bank that will allow for a fix and hold. So we could use that as your qualifying experience. And the reason that banks set these terms for qualifying experience, again, comes into, it's a risk assessment. So if you don't have any experience with new construction, it can be a little bit risky as far as being able to navigate the process. It's a little bit riskier to the bank, I suppose I should say, simply because the borrower may not have experience in managing projects like this. But so the more aggressive banks have requirements where you need to have, one of them, requires 3 in the last 3 years, 3 fix and flips or new constructions in the last 3 years. So we choose investors for you or banks for you that will fit your needs. And, if you are interested in these new constructions after you have the experience level, we may be changing investors for you to get you better terms. So with this one, we need a 620 minimum, and as I said previously, the better the score, the better the terms, and the more flexibility. Exposure limit. This exposure limit is set similar to the fix and flip. It's not a required minimum loan amount, but it's the exposure limit of the max amount of projects you can have going at one time. So typically the minimum is 500,000, and the bank will set that maximum typically somewhere between 3 to 5, and we have one that goes up to 10 million on these. But to get up to 10 million, you have to be a pretty high experience level, and you would have had to have done a number of new constructions within the last 3 years, new construction to sale. Loan term again on these is 12 months interest only, with 18-month options. 12 months typically is enough time to get a property done that an investor is going to be building, because you're typically not going to be building high-end custom homes to flip. I would say that's, typically you're going to be building more average homes, but it can depend on your market as well. Sometimes that 18-month option may be needed, just depending on how busy the contractors are in your area. So the short-term rental is the Airbnb or the VRBOs. We get a lot of questions on these products. These products are a little bit harder for the bank to figure out the debt service coverage ratio, because we're not actually going to be basing it on a monthly rental. So the standard terms that are used to figure out that ratio aren't typically applicable, because you're going to be setting this up, with multiple short-term rentals in a month typically. So one of the things that I've discussed with the investors is they may not lend to you on a short-term rental if they think that the area that property occupies, if they think that area is not going to generate enough income for a short-term rental, then they typically will pass on a scenario like that. So if you do want to do a short-term rental, if you're interested in those, just make sure that you're taking a look at data in the area, and that your area can actually handle that, can actually generate enough income to be acceptable to a bank, and also for your cash flow purposes. Refinancing these can be a little bit easier, because then we have a history. So if you own a short-term rental and you want to cash it out or just refinance it in general, we can look at your typically they're going to look at 12 months. Some banks may want 24 months, but 6 to 12 months is the usual. So we would look at that and take an average and figure out what your debt service coverage ratio would be based on that, on that average. This is our contact info. Kate's going to be sending this stuff out to anybody that wants it. And I think Kate's probably emailed you with contact info anyways. All right, Kate, you still with us? All right, does anybody have any questions? Sorry, I'm not the best at managing this.
I wanted to ask, should we just go online to access your application?
So it's different per investor. So typically I have a conversation with the prospective client, and different investors have different forms they want filled out. So I qualify you similar to a pre-approval based on our conversation. And once we have that conversation, we can I typically can I typically can decide which lender is going to work the best. And then, I'll either send you the form that we need specifically for that bank, or I'll take the information and then it gets entered, I enter it in the bank system. So it's a little different than a residential mortgage application, especially since we're dealing with different investors. We don't have a specific online portal because different information is required for different investors. So it's a upfront phone call and then we take it from there.
Okay, thank you.
You're welcome. One thing I wanted to bring up is two things that have come up in prior discussions. Seasoning of assets. And how long does it take to get one of these transactions closed, especially usually on the fix and flip, because some of these are, people the person buying the home to invest is looking to turn the transaction pretty quickly. So it really depends on what the requirements are going to be for that specific project. So about the fastest these things turn around is 2 weeks. And part of that depends on how quickly a title search can come back from the title company in your area. So, and if an appraisal is needed, that affects the timing as well. So a couple of the investors that we have here will do an in-house evaluation on probably about 90% of the business they do. If your project is a bit out of scope, where you need a lot more money than, what would be standard compared to your purchase price. If the property is in a quasi-rural setting, let's say, where it's kind of in between rural and suburban, anything that's out of the ordinary typically is going to prompt a full appraisal. So part of this comes down to you having an understanding, and this is a discussion you can have with me, of course, and I can discuss it with the bank, but understanding what is kind of out of the ordinary, we can decipher that typically with a conversation with me. That's going to give you a better idea on time frame. Title searches, you don't really know that until you are dealing with real estate in your area. A lot of states are pretty fast on the title search. So if we can do an in-house evaluation on the appraisal, we can do a title search that's quick. 2 weeks is a decent time frame to turn one of these over. And seasoning is the other question that came up, seasoning of assets. So some of the investors we picked up are now no longer requiring seasoning of assets. So you don't actually have to source and season money for down payment, let's say. So if you need $50,000 for a down payment, we aren't, depending on the investor, we may not need to ask where that money is coming from.
I went ahead and put our contact information in the chat so you can all see the office number. The cell listed is mine, which is also on my email, which I think I've emailed to all of you. And then that's our company email address and our website. So you can find us there. You did talk to them about scheduling an appointment with you to talk about their scenario.
Yeah, the question came up as far as how to apply. I said, that's typically a conversation we just have.
Yeah.
And then we send documents out for application. Any other questions? I think everybody's good.
I'm not sure where you're all investing right now, but Shane, why don't you talk about where we can, because that's come up before, as far as like what states we're able to lend in.
That also depends on the investor and the bank. We're restricted in some states, but we can do about, I think it's 44 of the states with our main bank. Other banks, it's between 35 and 45 states typically. So most states of the country we can cover. Some of them do require an LLC, but I touched on that earlier. So it is a good idea to have an LLC in place, even if the bank doesn't require it. You want that protection in case the in case a buyer sues you, or if somebody gets hurt on the property while you're renovating it, or, there's a number of reasons you would want to have an LLC in place to protect yourself.
Louisiana is a state we can lend in. Someone said they're in Louisiana. So yeah, that's a good state for us.
Something that's come up with some of the prior discussions is where money can come from. And are there options out there to do this without any of your own money? Usually in the scenarios we're talking about, you do have to have some money in the transaction. You may be able to find another investor or someone that's willing to lend you the money that you need to meet the difference between what the bank will give you and what you're going to have to pay for the property. So the fact that we don't have to source and season funds with some of the investors does open that up a little bit more, so that you have more options for where you can come up with your money. But in general, you do need some money in the transaction. All right, I think we'll wrap it up.
Yeah.
If anybody else has any questions, let us know. You've got the contact information there. You can email us or call us. Kate is text friendly. So, all right, thanks for your time. And if you have any questions, or in the future, if you want to set an appointment, just let us know.
Yeah, thank you. Email any questions you might have as you're working through your properties and your scenarios. We'd be happy to help you and answer any
Thank you for
questions.
your time.
Yeah, thank you, Teresa, for coming. Thank
Yes, thank you.
you very much too.
All right, I'm going to end the meeting here. Bye, everyone.